January 21 natural gas futures crashed mid last week, down from $2.93 to $2.46. Prices bounced to $2.57 at Friday's close, up 7 cents. Selling was primarily attributed to the weather data trending warmer for mid-December after teasing something colder at the start of the week. It didn't help lower 48-state production held the recent jump from 86 to 90 billion cubic feet per day. But with the past 3 EIA weekly storage reports printing bearish versus expectations, production very well could be stronger than reported. The weekend weather data held a bearish overall U.S. pattern the next 15 days, apart from a modest bump in demand December 14 to 16, as cold shot exits the west-central U.S. and tracks across the east. Besides this period, the coming pattern will be warm to much warmer versus normal over most of the U.S., especially the important Midwest region by 15 to 30 degrees Fahrenheit most of the next 15 days. What makes the pattern emphatically bearish is the weekend weather data shows an impressively mild pattern December 18 to 22, with almost the entire U.S. warmer than normal as the frigid Arctic cold pool remains locked over North Canada. It's worth noting the European model isn't quite as bearish as the GFS, but the European model has been too cold in numerous instances the past few weeks, ultimately giving demand back in time. No major changes with December weather patterns failing in grand fashion to cash in on the tighter supply-demand balance that's been aided by LNG feed gas at record levels near 11 billion cubic feet per day, including this past weekend. Lower 48-state production remains near 90 billion cubic feet per day, suggesting a slightly tighter balance compared to late last week. This week's EIA report should print a slightly larger than normal draw due to a mix of mild and cool conditions over the U.S. last week. However, the following 2 draws will again factor in warmer than normal weather patterns for a return to smaller than normal draws.